You just sold your house for $700,000. Search capital gains tax on home sale, and every result hands you a rate. The rate is not what costs you money. Two sellers with the identical house and the identical sale can end up $18,000 apart, and it has nothing to do with their tax bracket. It comes down to one number sitting underneath that rate, and most people threw away the paperwork that proves it. Start here because almost everyone has this backwards. Capital gains on the sale of your home are not calculated on your sale price. They are calculated on your gain. Your gain is what you sold for minus the costs of selling it, minus what the house cost you. That last figure has a name. It is called your basis, and it is where all of your leverage sits. Let me clear out the two things people confuse with it. Your mortgage payoff is not part of this calculation. If you sold for $700,000 and wired $400,000 to your lender that afternoon, you did not have a $300,000 gain. Repaying the bank is a separate transaction from the tax you owe, and the cash that lands in your account is not your gain either. That is proceeds, and the tax follows the gain. So let's build the number that actually matters. Your basis starts as what you paid for the house plus the closing costs you paid when you bought it. Then it grows. Every capital improvement you made in every year you owned that house gets added on top, and there is no time limit. Work you did 19 years ago still counts today. Now, the distinction that decides your whole return. An improvement adds to your basis. A repair does not. An improvement adds value, extends the life of the house, or adapts it to a new use, a new roof, an addition, new windows, a replacement heating and cooling system. Those go into your basis. A repair keeps the house in the condition it was already in. Fixing a leak, repainting a bedroom, replacing a broken pane, those do not. The test is not what you spent, it is what the work did to the house. And the Internal Revenue Service publishes this distinction in Publication 523. Here is why sellers lose this money. The improvements are real, they happened, and the receipts are gone. So people take the easy number, the price on the deed from the day they bought, and report a gain far larger than the one they actually made. Let me run it slowly with two sellers who owned the same house. You bought in 2004 for $210,000 and paid $4,000 in closing costs to buy it. Over 22 years, you replaced the roof for $14,000, remodeled the kitchen for $38,000, put in a new heating and cooling system for $9,000, and replaced the windows for $15,000. That is $76,000 of improvements. You sell for $700,000. Commission comes to $35,000, title and other closing costs run $5,000. So $40,000 leaves the table on the way out. Seller one keeps no records. Their gain is $700,000 minus $210,000. $490,000. They are single, so they take the $250,000 exclusion and they report a taxable gain of $240,000. Seller 2 did the work. Their basis is $210,000 plus $4,000 of purchase closing costs plus $76,000 of improvements, $290,000. They sold for $700,000 and subtract the $40,000 it cost to sell. So they realized $660,000. Their gain is $370,000. Same exclusion, and they report a taxable gain of $120,000. Same house, same sale, $120,000 of difference in what gets taxed. At a 15% rate, that is $18,000. And every dollar of it came off a piece of paper somebody either kept or did not. Now the rate, because there is more than one running at the same time. If you owned the house longer than a year, your gain is long-term, and the long-term rates are 0, 15, or 20% depending on your taxable income for the year. Those bracket cutoffs move every year, so look up the current table rather than trusting a number in a video. Then a second one stacks on top. The net investment income tax adds 3.8% once your modified adjusted gross income passes $200,000 filing single, or 250,000 married filing jointly. A large gain can push you across that line in the year you sell, even if your salary never goes near it. And a third one catches people who did the right thing years ago. If you ever rented that house out or claimed a home office deduction on it, you took depreciation. That depreciation gets recaptured when you sell at a rate of up to 25%, and the exclusion does not cover it. It is owed even by sellers who fall comfortably under the exclusion on everything else. Three things, and the first matters most if you are not selling yet. Start a basis file today. One folder, physical or digital, for the house you live in now. Put the closing disclosure from the day you bought it in there, and every invoice for work that changed the house rather than maintained it. Second, if you already sold or you are under contract, go backwards and reconstruct. Your county permit records show the work you pulled permits for, with dates, and your bank statements show the contractor payments. Most contractors will reissue an invoice if you call them. Third, get the depreciation question answered out loud before you sign anything. Was this house ever rented, even for 1 year? Did anyone ever claim a home office on it? If the answer is yes to either, your number is not the simple one. And that is a conversation to have with a tax professional before closing, not in April. If this was useful, subscribe. I run the numbers on one of these every week.